Hello and welcome to the Trading with Ashley show outside edition. It is just so nice outside. I wanted to come outside and visit with all of you. Before we go any further, I need you to do me a favor. As you know, most of you know that have been following me, I recently gave up my channel and moved to another channel because I own this channel 100% myself. And I need to build up my subscriber list because I was at 25,000 subscribers and I'm slowly clawing my way back. And you can help me. If you will just press that subscribe button, that will help me a lot. Press like on the video. And then if you feel so compelled, maybe share this video with some of your friends if you think it may help them. I think you're going to love what I'm sharing with you today because it can potentially increase the funds that you decide to invest by 50% in the next 12 months based on the trajectory of what we have going on. So before we go much further, I'm going to show you this little video clip and it helps explain where Tom Lee, who's one of my favorite analyst, shares where he thinks the market's going.
Tom Lee, thank you for being here. Tom Lee, I don't even know if you need an introduction at this point. People tune in to hear. Sometimes it's almost like a salve. And I think you're going to give us a little bit of that today for our wounds from yesterday, but not entirely, because you think the S&P is probably going to be flat for August overall.
Yes, that's right.
And that's unlike some of your recent calls about the S&P with friendlier inflation data. You've made some calls about some big near-term moves. That's not what you're saying today, unless you're talking about small caps.
Yes, that's right. I think part of what we saw yesterday was, the rotation that's painful away from large caps. And I think Tesla earnings and Google sort of accelerated some of that. And I think there's been some uncertainty about the Fed's commitment to cutting, even though we expect inflation to fall like a rock. But when the Fed starts cutting, that's good for small caps. And there has been, I think, overseas, some unwind of that Japan carry trade that's hurt the NASDAQ. But to me, this is why the S&P had a great first 6 months. Maybe it needs to consolidate those gains. But now Russell 2000 has an 11 median PE, earnings growth 800 basis points faster. And it just posted 11 days where 10 out of 11 days had a 1% move. The 9 times it did that since 1979, when you weren't in a bear market, we were up 100% 1 month, 3 months, 6 months, 12 months later. 12-month average gain 40%.
You don't think the large caps are done. You just think it's a slowdown for the S&P 500. That's their level.
Yes, that's right. I think the Mag 7 was very attractive at the start of this year because growth was scarce and they've had great visibility and they're not expensive. 27 times earnings isn't demanding, but now that there's a visible catalyst for small caps, I think investors are taking some profits up. NASDAQ was up 20% and putting it into small caps.
We were talking earlier, though, just about the Mag 7 in particular and the spending on the cloud. If Alphabet's results are indicative of what we might hear from Microsoft and Amazon next week when it comes to the cloud, where they are spending a lot more than they're able to bring in at this point, is that a problem? Is that because it feels like there's a little bit of a sentiment shift too?
Yeah.
Even if it's a brief one and early on.
I agree. I think perception is really important for equity valuations, but the money spent by these companies on AI has a high expected return because they have moats that are getting stronger, and there aren't companies like this anywhere else in the world, so they're very scarce. So I don't think it's wasted capital, but if investors want free cash flow or if they see 11 PE stocks and small caps, that's what's becoming incrementally attractive.
So a flat S&P, but a Russell or a small cap gain of 15% in the month.
Yes,
possibly. Yeah.
That's right. I think for the month of August, small caps can do something more than 15% even because they've underperformed so dramatically. And the type of move we've seen just in the last 2 weeks is something that only happens at the start of a pretty significant advance for small caps.
Once interest rates come down, there's 3 distinct sectors that I think stand to benefit the most. I want to take you through those and share with you how to trade them. And it's through a trading vehicle called ETFs, Exchange Traded Funds. The Exchange Traded Funds actually is what the SPY is, and all of you are familiar with the SPY. And it actually helps making investing a little bit safer because you are dealing with a conglomerate of companies, a basket full of a lot of different tickers that help you insulate yourself against wild swings in one company. I mean, let's face it, especially some of these smaller companies that we're talking about, they have a CEO change and then it changes the trajectory of the company. And so you are very vulnerable if you're going into some of these smaller operations in single tickers. So I wanted to pull together my 3 sectors that I think are going to have the biggest movement with this new lower interest rate environment that we're looking at and help you better understand how you can use these to grow your wealth. Now, the 3 sectors that I'm going to talk to you about today are small cap companies, which you've heard that a lot in the news, so you're probably familiar with that one. Regional banks is another one. And then we have home builders. And I wanted to explain to you why I think each of these sectors stand to have increased activity in their funds as a result of this new lower interest rate environment. First of all, small caps. Well, small cap companies rely on borrowed funds quite a bit to make their operation not only run, but to increase maybe the marketing. Maybe they have new product that they want to introduce or that they want to purchase to share with the broader market, and they can't do that if they don't have the funding to do so. Well, once they see that rates are coming down, they will then have more confidence to actually borrow the funds to make their business run. Now, if you're an investor, that interests you because you want to get in on companies right before they start making more money, because then your money will grow as their money is growing. So that one may be pretty easy for you to grasp. Now let's talk about regional banks. So regional banks are not your big name banks where you have to dial up and talk to somebody probably in another country that's not even here when you're wanting to borrow money. They are your smaller banks that the president or CEO of the bank probably is in your community. Their children probably go to school with your children. And that's more than likely who you turn to borrow money from if you want to purchase a car, get a personal loan, refinance your home, build a home. And those banks make their money from the fees, from volume. Well, the volume has been much slower, obviously, due to the lack of borrowing because we have higher interest rates. Well, lower interest rate environment usually causes a flurry of activity for these regional banks. So they stand to have a lot more fees coming through their system as a result of this flurry of activity. Now, when they start reporting in the coming quarters, you will see this on their balance sheets, and that will increase investor confidence in their businesses, and you will see those tickers start to take off. Now, let's talk about the last one that I think is most exciting, because this is one that's actually what we've been waiting on. We had actually had plans to build a new home a couple of years ago. That's when interest rates started climbing, and we pulled back and we just said, you know what, we're just going to wait until the interest rates start coming down. So this particular sector is the home builders sector, and it too stands to gain a significant flurry of activity because you have a lot of individuals that have prepared everything they need to build a home. They have their plans like we do, and they're just waiting on the green light. We have our builder, we have our plans, we have everything. We just haven't borrowed the funds yet. And so once that happens, you are going to see these companies that focus on home building have, again, a flurry of activity. And when they report in the following quarter, that's when their stock is due to fly. So you want to get in on all of these just as everything is starting and not after all the news is known. So I am going to now take you inside. We're going to go into the computer and I'm going to show you how this will work. And I'm going to give you 2 options with ETFs. I will have the initial option that is just the simple ETF, which is the basket of stocks in that sector. But then I've also done some research for you, and I will also show you a triple leveraged ETF for each of these sectors. Now, triple leveraged is great because if, let's say, the sector moves up by 5%, well, the triple leveraged will move up by 15%. But you have to be careful because same thing can happen if it pulls back and on the downside. It will go down 3 times as much. But if you have confidence and you feel good about moving forward, then this is a way to grow your money even more. I pulled together some research on the interest rates since they affect all 3 sectors that we are talking about today. And I wanted to show you how rapidly they have risen. So if you were going to get a loan back in July of 2021, you could have expected to pay for a mortgage 2.8% 30-year and 2.28% for a 15-year. Just a year later, we were close to 4% on the 30-year, 3.45% on the 15-year. Then 1 year later in 2023, it's a whopping 5.35% for a 30-year and almost 5% for 15-year. And here recently, we have almost a 7% 30-year mortgage. If you're looking at 15-year, it's about 6.4%. Now, this is illustrated even more poignantly when you see it lined up year to year and you see how aggressively this interest rate has grown. But hopefully, once they start coming down, we start to see the activities in these sectors pick up that we have been discussing. Now, I'm going to take you to the actual ticker symbols so that you can trade these this week. The first ticker symbol I wanted to go over with you was the Russell 2000, which is comprised of our small cap companies, and it is ticker symbol IWN. And you can see that it has recently risen, but I don't want this to scare you because it is just at the very beginning of its cycle. And typically when you see a stock rise like this, you might say, I'm going to wait to pull back. We're up 10% in the last month. And you can, because just nothing goes straight up. But what I have been sharing with my students is you probably want to start getting into position now, at least with some of your funds. And then on these pullbacks, like you saw that it happened here, go ahead and add more. And then you can maybe dollar cost average along the way. And then when you see these little valleys, you double up. And that way you will average down your price this as best as you can. But we are expecting this to continue to rise regularly throughout the year. Now, I had mentioned a 3-time leverage play on small caps. That is ticker symbol TNA. And you can see here where it's being priced at. But I thought this would be fun to compare the ticker symbols of the standard ETF compared to the growth that we see in the triple leveraged ETF. So when you put these together on a graph, you can see the outsized growth of the 3-time leverage play here in the blue compared to IWM. But you can also see when it dips, it has a much steeper dip than IWN. So visually, this shows you what you can expect. But let's assume that you feel confident that it is going to move up and continue to move up. You could take a third of your funding and put it into this ETF and have the same results because it is triple leveraged. It's ticker symbol KRE, and it represents the regional banks. And if you wanted to look at the triple leveraged option, DPST is the triple leveraged version for KRE. And now we'll compare the two. Here they are compared side by side, triple leveraged and just your standard ETF. And your home builders ETF that I was mentioning to you is ticker symbol XHB, coming in at about $116 a share right now. And its 3-time leveraged counterpart is ticker symbol NAIL, which I thought was rather clever to use ticker symbol NAIL for home builders. And here they are compared side by side. And I tried to make this easy for you. You can take a screenshot of this. You will see the triple leveraged ETF to the left, and then I went ahead and put its 3-time triple leveraged counterpart to the right. One thing you want to consider is with the triple leveraged version, they do have aggressive management fees, and that can erode the price of the ETF. So you want to be careful and consider how long you hold it. Basically, if the stock is going sideways, it poses more risk than if it's continuing to rise. Now, I've heard from a lot of you that want to join my Discord or you want to be involved in my next boot camp. I am accepting new students right now, but we're almost full. So if you're interested, go ahead and click that link below, and then we'll book a brief call with you. We'll show you what Discord's all about. We'll tell you about boot camp. We'll go over the pricing, and you can decide if you want to join us come next week.